Hey Chris, what's going on?
Hey, good morning. I'm great. How are you?
I'm really good. Sorry about this lighting issue. I'm still trying to. I look like I'm sort of kind of creeping out of the darkness on this.
No, you look celestial.
I like that. I like that.
That's a big word for a small brain. It's a good one for me. I'm getting there.
What a word a day, man. Just a word a
I
day.
think the thing is, I've decided if I don't learn a new word every day, I'm just falling behind the curve, man. All
There's
of
a lot
this
of
young
words.
speak is killing me.
There are a lot of words out there. You gotta get cracking on those, especially in English. There's just some random. We have a lot of words in English.
We have a lot of words and we don't use a lot of them.
That's true.
So I'm going to try and learn a word a day.
I read somewhere that, and this is pretty bad for Americans, especially. It's like English has is one of the most extensive vocabularies and has one of the one that we use the fewest words in. I mean, like compared to other languages, we use the fewest of our words than more than most.
I think I think the most used word right now in the English language has to be the word like.
Yeah,
And there's nothing that drives me more insane than when you're hearing some Instagram video and it's like, I like that, like I just wanted to like slap them because it sounds like, remember in the old days when we had those vinyl records and it would get scratched and it would repeat itself and it sounds like the brain's doing that for these young people. It's like they need a little bit of you got to bump the record player a little bit.
you're skipping. Yeah, I agree, man. It's crazy. Definitely, people could work on their speaking. Probably me too, half the time. I'm tired in the morning sometimes, and things don't come out. So if you guys don't understand what I'm saying, don't worry about it. Just listen to Chris.
I'm the same, man. I'm like the only word that I use a lot now is tap 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 tap. No. Let me out. Let me out. The most used word in my vocabulary right now is the help me out, man. I'm suffering. That's the thing. How are you? Otherwise, all good.
I'm good. I'm good. I training's
Awesome.
good. Um, what do you think about this? Is this the Q4 rally? Are we headed into the?
Man, you know what? If you remember, I think last year. Sorry, I'm just turning on my heat pack. Like you're getting older when you got your heat pack.
Oh yeah, yeah.
It's interesting. I'll let me share my screen and I can show you what I'm seeing. Okay, so here's SPX, right? And this is the hourly chart. Let's switch it on to the daily, and you'll see a lot of colors and everything. You can tell I've been bored, so I've been drawing a lot of things. And what we see is we had this decline, right? That was the decline that happened. We came down, we were fairly extended. And as always, right, we get the reversal, right? So we got the reversal from the second Kelta, came up. We had a moving average cross. So this is where the 8 crosses the 13, right? So this is one of the indicators that I've built. It's just a very simple moving average cross indicator. Now, from here, where you see this momentum reversal, this blue diamond together with this green column, that's a really strong signal to enter a trade, right? So we landed up going long on SPXL, which is the triple leveraged S&P 500, on the back of that signal. And again, you don't need a lot of brain power when your signals are doing all the hard work, right? So let's not assume that there's some intellect that goes into that decision, right? It comes up on the screen and you do what it tells you to do, right? As per your plan. But this is where the key is, right? As we pass through, you see this Ichimoku cloud, this green area. This was where the market started to look, it could fall down again, right? We can always see degrees of resistance forming when we trade within a cloud. So this wouldn't have been a one whole lot position. This would have been a partial position. And there was your breakout back into this channel. You see these two blue lines? Once we crossed into the channel, it was pretty much gap up, moving up day on, day in, day out, right? So we had this really extended rally from the passing of the Ichimoku cloud when the 8 crossed the 13. Here's where the concern is. When we get too extended to the upside, we tend to fall back, right? So this is the question now that comes up is, are we going to fall from here back down to this line? Because that wouldn't be a huge reversion at all in terms of price. That's moving from 46, let's see, 46.10. We could probably come down here to 45.15. That's 100 points. That's a big decline, right? So is this the rally that starts us off going up into these areas here at the 4,800, looking at around December time, right? Or are we going to go up, come down, up, come down, and sort of do this zigzag pattern? Now, if we go back to last year, what we had was a very similar scenario. We had a decline. We had the same kind of decline. We had a rally, and then we had another decline. And it was the back of that decline that bounced us back up to the highs in March or February, right? So I'm a little bit, if I have to listen to my gut's telling me you trade the chart that's in front of you, all right? You don't try and second guess this market, because if you go short here, you can get wiped out because the market will just grind to new highs. If you go long here or too long, all right, you could get wiped out on a decline down, on a reversion to the mean. So I think it's a 50-50. I think it's one of those things where if you've got a proper trading plan that says, you know what, I'm going to trade the 813 crossover to the upside. I'm going to wait until I get my signals to tell me to get out. And this will keep you safe. All right, this will keep you safe. You trade that until such time as this red column appears. When that red column appears, you close your position and you wait for the next green column. It's not that hard. The problem that comes in with a lot of people, two things. The first one is people become indicator junkies. And I'll be honest, I'm a bit like that. I will build new ones every week. You know, I'm always looking to find this new edge, this correlation that's not common, right? I think the more common an indicator is that's used, the less effective it becomes. All right. So there's a big element of that. So, you know, when I see these adverts that come out where, you know, trusted by millions of traders, I'm like, well, how much of an edge do you really have if millions of people are doing it, right? So, you know, I try and avoid that. I look for the correlations between uncorrelated indicators. All right. So I don't like it when I've got all the same indicators telling me all the same things. I like looking at it from maybe 10 different angles, and telling me, if this one is looking at it from this perspective and this one's saying from this perspective, and they both come to the same conclusion, it's a far more robust decision. So when we look at these, I'm looking at momentum and I'm looking at price candles. I'm looking at, the price action and the momentum mainly here, right? So if we just trade the chart that's in front of us, I'm just going to stay long until I get an indicator that says sell now. All right. So when it says sell now, I will exit the trade and I will move on. And I think that's the safest way to approach the market rather than trying to predict. These indicators can be quite, they're very good at timing. All right. And I think this is one thing that most traders often get wrong is they either enter a trade a little bit too late or they get in a little bit, they enter it too late and they exit too late, right? They're always, 3 or 4 candles behind where the action is actually taking place. And what we're looking at here is, these indicators here give you an early warning sign for price action to come, right? So that's the way I'm trading it right now. I would be cautiously optimistic.
I think you have to use a confirmation candle on those indicators, like a next second day.
Yeah. So what you would always look for is, here's the indicator, right? We always trade the next candle, right? So if the next candle opened up lower than the candle where the indicator showed, you wouldn't trade, all right? You just wait, all right? This is your confirmation candle. You can see that the low of this candle was higher than the open of the candle before, and we had a higher high, right? So we had a higher low and a higher high, and then, your price goes off. Now, what trade would you do here? All right, so we're options traders. We're not stock traders. You could buy shares if you wanted to, but we were basically selling a lot of at-the-money bull put spreads, and we were just taking credits on these, right? So we've had about 30 or 40 trades in a row that have actually worked out really well. And you just trade them, all right? So you can use the same indicators on different time frames. This is the hourly chart. You can see there is our buy signal over here. If you'd been selling put spreads or buying call options, that would have been a really good trade. There would have been your exit. There's your entry. You would have entered on that candle, exited over here, and you're out. You would have gotten back in very, very quickly afterwards, and you're still in the trade. So, you know, the thing is with indicators, a lot of people are looking for the holy grail. There is no holy grail. The holy grail is really your interpretation of how it fits to your plan. You know, I have a collection of, I don't know, maybe 20, 30 indicators that I use. And it's the relationships between them that make the edge. It's not the indicator by itself. You can't trade. I don't believe that you can trade effectively on a single indicator. It doesn't, I don't think it's a practical way to do that, right? Because not in you know, a single indicator doesn't have 100% success rate. It's the correlations between these indicators, right? So I use momentum, I use price action, I use candles, I use the Ichimoku cloud, I use the 34 EMA. I use a lot of things when I build trades, and it gives me a slight edge because of that relationship, right? It takes me out of bad positions and keeps me in good ones. But you know, looking at the market now, I think this could be the start, right? I think it could be, but you know, it could always reverse on me, and then you're wrong, right? So trade the chart in front of you. Make sure your indicators are set up to give you the indications at the speed at which you can trade. This is another important point. You know, a lot of traders will trade short time frame charts, but use long time frame indicators. You've got to make sure that you get that synergy right. The speed at which the signals print will always determine how good you are as a trader. If you're getting signals that are too frequent, all right, they're coming one candle after the other, like here, that can be quite damaging for someone who's not sitting in front of the screen. You know, it becomes difficult to trade that, because as soon as you've exited one position, you've got to enter back into another position. It can be quite tough. So you have to make sure that you test your indicators for the speed at which they print, and then see the application, see your win rates. You know, don't just blindly put an indicator on and then follow it. That would be crazy. You know, really work the indicator to fit into your trading pattern. So, you know, a lot of guys who don't sit in front of the screen, you know, the day chart is the best time frame, and then using the signals on a next day basis, right? So if I got print that, you know, if the signal printed at the end of the day on the 15th, you would enter your trade on the 16th. All right, you would go in on the 16th. You'd see the open. Is the open higher than the close of the day before? Or, you know, is the low of the day? You would go in around 3:30, 3:45, and you would enter your trade. You would buy in on that candle. And that's how you do it. You've got to find what works for you. I think a lot of these guys that sell, you know, trading systems, so to speak, thinking one size fits all, or trying to encourage a one size fits all mindset to, you know, a trading population that's incredibly diverse. Everyone's got different goals, personalities, experience, etc. You know, it can be quite frustrating for a new guy coming into the trading environment and then saying, oh, well, it must work because it's working for all these other guys. And then he tries to mold himself to their style. And that's not healthy at all. So yeah, long story short, I think we've got some opportunities. You know, our trade on SPXL is up a couple percent. We've been adding. So one of the rules that we have with SPXL trades in the fourth quarter is that as the trade starts working, we add to the trade at certain positions. So as the trade gets to 50% profitability, we add a second leg. We go out further in time. We do another contract. So what we have is an opportunity to build the trade in a rising trend. And when it reaches our profit targets, we can start peeling off some of the initial trades that we had. So we've always got the exposure to the trend, but we're taking profits along the way. So we're not overexposing as a position.
So what levels do you like to add? At what levels do you like to add?
Usually my first position, I will add a second position at 50% profit. So once that first trade is at 50, I'll add a second trade. And then once that trade is at 50, the first one should be at around 100. I can peel the first one off and add a third trade. So you're always sitting in a profitable position with that trade. Sometimes it's going to be, you know, here's SPXL. Let's actually put SPXL onto a graph here. So with SPXL, there was our buy signal. So we got in on the breakout here of the Ichimoku. Now remember, this is a triple leveraged position, right? So it moves a lot faster than if you had traded SPX or SPY, right? So what we did was our first initial position, we got in over here. We had 3 confluent buy signals in a row, right? 1, 2, 3. So we had 3 buy signals. These are all different algorithms that are calculating that signal. So we got in around here. The first profit position was here at the extension to the third Keltner. We added another position. So we had 2 positions there. It pulled back. Here was our third position. We added another one yesterday on this rise up here. Now, if this pulls back, the first position here is very profitable, right? If this one pulls back, if it pulls back in our trade plan, we're going to add another position, all right? Because we are in the trend. Now we're stuck at the top of this trend line. You see this channel that's forming, these 2 blue lines. We could see a pullback to the 8, all right? That is highly possible. If it does, if the price pulls back here, sorry, I've got a frog in my throat. I have the amphibians of my town taking residence. If we have a pullback to this price level, this is where we're going to exit the trade. All right, this would have deemed the trade broken. Now, every day, what we do just to manage the position is we drag this up. All right, we drag it up. So in a rising trend market, you keep increasing your stop line. All right, my profit line stays where it is. All right, so we calculated that up front from our Fibonacci analysis. We leave it up there. And now we just let this rise. So if this breaks through the upper channel trend line and it's going to go to the profit line, we just keep moving this up. All right, it keeps moving up. And if it breaks that line, we take our profits and we wait for the next entry signal to come in. That's trade number 1. Trade number 2, we wait for the red column to appear. Right, so when that red column appears, that will indicate exit all positions. Right, so this trade would be take your profits on the first leg. All right, and then once that's out, we then establish a new stop line on our second position and we keep moving it up. So that allows you to stay in good trades and exit poor trades. Like once they break, they break. And you shouldn't expect all trades to work perfectly, right? Not everything's going to be perfect at that time. Now, obviously, this is for long calls, bull call debit spreads, call butterflies. You could use this for any of the trades. But in the fourth quarter, the most money you're going to make is going to be from out of the money call debit spreads and long calls, right? So what you're trading on are these big movements, right? These big movements that happen when we get the blue diamond together with across this green column. When we get the blue diamond and the green column together with what we call a range breakout, those are very powerful moves, right? Those are precursors to powerful price movements. So buying a 30 delta call option on the back of these 3 signals together often can result in explosive moves in price. So you could buy a 20-cent option and, you could see that 20 cents become $1 in the next 2-3 days, right? So we've seen that a couple of times. We did a trade on DCRC. This was a very, very quick trade. We got a buy signal a couple of days ago. This was on Friday, Thursday, Friday last week. That was Friday. So we got a buy signal before this explosive move. There was our 1 signal, second signal, third signal. On the confluence of 3 buy signals, you buy an option. We bought I think it was a 20-cent option. That was 90 cents yesterday, right? 20 to 90. We've taken profits. We've now got a second trade in. And you can see it hit our profit target perfectly, absolutely perfectly. We took profits at the top. We're risk-free on the trade, and now you hold it. These are quick trades. I think we did this at 3:58. I think it was like right at the end of the day. There was like 2 minutes left. But it's about the confluence of signals. When you've got a range of buy signals looking at the trade from different angles and all telling you the same thing, man, that is a system worth gold, right? That's a gold system for you.
Excuse me. I have the same thing. I just allergies. Excuse me. Why do the 30 delta call options respond so dramatically to those price movements?
The way that I interpret it is the 30 delta call options tend to explode in price better because you're not overpaying for it, right? So because you get these volatility expansions, they react probably better than most options to increase it. They respond from a delta perspective faster to the changes in volatility than other options, right? Remember, when you're buying an option that is 0% intrinsic value, 100% extrinsic, right? Remember, there's time and volatility that sits in the extrinsic component of valuation. And if that volatility explodes to the upside, that option is going to increase in price really quickly. If I buy something that's in the money, all right, I've got an intrinsic component that takes up a portion of the valuation. Then I've got the extrinsic piece, the time and volatility. And the volatility portion is a smaller component than if it was at the 30 delta, right? Okay, 30 delta, 28 delta, 16 delta. It's all the same, right? It's just the volatility component of price is a higher component of what you paid, and it's largely more sensitive to that rise in volatility, right? So 30 delta options, when you're buying them and you get these explosive moves to the upside, all of that is volatility. All of that is volatility, as opposed to intrinsic, as well as obviously you're losing time every day when you've gone long. So looking at the 30 deltas, I use them because they are affordable, number one. I can buy more contracts. I can get an increased delta. But to do the 30 delta well, you have to have the momentum and the confidence of the directional move. You need that explosive directional move. Now, you could go further out in time, all right? And you can do this with things like Tesla, for example. If you took a Tesla 30 delta call debit spread for 2024 or something, you know, you go way out in time. You're taking a bet that Tesla is going to be worth more than the short strike of your call debit spread at the end of 2 years. Okay, so you could do that. And if you've got a bet that Tesla is going to be, you know, higher than that strike, then that's an easy trade to do. On some of the smaller stocks, you've got to get your timing right. The biggest issue with out of the money call debit spreads and long calls is you need two things to work for that trade to work out. You need the amplitude of the move, so you need a big move and you need it quickly. That's what you need. You've got to get time and you've got to have size. Those are the two things that make the trade work. So if you've got something like, you know, it's trading with a low IV, right? So it's a cheap stock. It doesn't tend to move. It's not going to be explosive. You can see in the history of the stock, you know, it doesn't have these types of big candles, right? It doesn't have these big candles. The trade's pretty much going to go to zero. It's not going to work, right? What you're looking for is explosive potential, all right? So you need to be still looking at your squeeze. You still need to be looking at all the other indicators, all right? You need to still see the squeeze. You see what happened here? We had 3 buying signals all in a row. And look what happened down here. Our B score was going up above 50, major advantage, all right? So this is where we start getting the difference between the on chart and the off chart indicators, right? B score rising, that's number one. We had a breakout of volume, all right? You can see volume starting to increase higher than the average, all right? Here we can see on this candle just how big the volume was relative to the average, number 3. Now that's the second thing. Third thing, look at the squeeze, compression, 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 compression. All of these dots are compression, compression, fire to the upside. There it was over here, right? On that candle was the fire to the upside. Okay, so we had buy signal number 1, buy signal number 2, buy signal number 3. Oh, look over here, buy signal number 4, buy signal number 4. That's how it works. And then look at all the moving averages are all green. There was no doubt in my mind that once we started to build the position over here, that the price was going to explode to the upside because we had the indicators telling us that. So when you trade, be very, very cautious about just taking one signal by itself. That's not a good thing. Always look for confirmation, either through candlesticks, either through secondary indicators. That's one thing that I've learned is that some indicators, I call them primary indicators, and I've got secondary indicators. I will never trade a secondary indicator by itself. It has to be validated in some way, shape, or form by something else. All right. So a secondary indicator for me are the ones that are the most commonly used. All right. So remember, every trader reads the same books, right? Everyone reads the same books. We all know where your stop levels are going to be. All right. So everyone knows that the stop levels are going to be at the low of the previous candle. So when the algorithms go hunting for those stops, they flush you out because they know that there's a lot of liquidity sitting at those price levels because everyone trades the same way. This is the thing that gives you the edge. If you know what everyone else is doing, don't do it. Like, just don't do it. All right. So if you know that 75,000 people are using the same indicator, all right, to build a trade, don't use the same indicator. All right. You know, you might land up all being on the wrong side of the trade together, right? Remember, the market is an efficient mechanism to take money out of your pocket and give it to someone else. That's how it is. And your job as a trader is to put a little fence around your pocket and stop that from happening. The only way you can stop that from happening is to create an edge in a trade that guy doesn't see. So one thing I try and teach my clients is always imagine the guy on the other side of the trade is a hell of a lot smarter than you and has got access to a lot more data than you have. So if you know, it's like going to a jiu-jitsu tournament. If some guy's wearing a white belt, but you know deep down inside that the guy's a 5th degree black belt in judo, and he just happens to be a newbie at jiu-jitsu, you're not good. Remember my story about what happened to me when I was fighting a guy who, you know, was a big judo black belt and I was just a blue belt. You know, you've got to imagine the guy on the other side of the trade is a badass, you know, yacht owning billionaire from the Hamptons kind of thing, right? Who's got thousands of analysts working for him. How do you get an edge on him? That's the thing that you've got to try and remember as a trader is how do you get an edge on him? Not everyone that you trade against is going to be a beginner. You know, you have to really try and look for your edge. So, you know, everyone's edge will be different. You know, someone's edge might be how they look at trading. Your emotional control when things go wrong couldn't be an edge to some people. You know, when suddenly we see red everywhere and some guys go, great, it's time to buy. That's an edge. You know, if your reaction when things are red is, oh no, the market just, you know, crap the bed, I've got to fly, I've got to close everything. That might be your Achilles heel. And there's going to be someone on the other side who's willing to take those positions off you at a cheap price. So, you know, one thing you've just always got to remember as a trader is protect your capital, but don't be afraid to create your unique edge, right? So your unique edge is going to be the confluence of indicators, using a combination of indicators that might not be common. You know, one thing that I do with my indicators is I don't make them public. All right. I always say to people, if you want to use them, you just send me an email. I'm very sensitive to how many people use the system that I build because I don't want to give away my edge to people for free. That's not cool. You know, like I don't want to give it away. So, you know, anyone out there, if you want to do it, sign up at rogueinvestors.com/alpha and then send me an email and I'll be happy to show you how to use these to help build your trade plan. It's really important. You know, so when I see these, you know, these things being sold on Facebook and so on, you know, I'm just wondering over time, the edge will diminish because more and more people start to use the same thing. It becomes less effective.
That's pretty much the same way it is in jiu-jitsu. Like a technique becomes popular, then everyone learns how to defend the technique. So you have to create new variations of the technique.
Absolutely. There's so much overlap between the martial arts and trading. Like I didn't realize it, but you know, I read Hickson Gracie's autobiography the other day, and you know, the first page was about leverage and about, you know, doing the things that are unusual and looking for advantage and positional advantage and stuff like that. It's the same in trading. You have to apply that mind.
Is that book good? I was getting ready to order that actually.
I couldn't put it down.
Awesome.
I mean, look, it's one of those books where, you know, I think Hickson's a great guy. I would love to meet the guy. I think what he sacrificed from his own body in terms of the sport was, you know, immeasurable, right? My favorite part of the story was actually where in the book he talks about his match with Sergio Pena. And Sergio Pena is one of my favorite people in jiu-jitsu. So that was like, hey, I even went to my wife. I was like, look, you see, here it is. It's like a full page of his match that he had with Sergio. And Sergio is a great guy. So if you're ever in Vegas, you got to head down there to train with him. It's a great book, really, really good book.
Cool.
And it's a very honest book as well. He talks a lot about how, his father and his uncle weren't exactly the nicest people. It's one of those things. And I think that's important. Even more important, though, is I think Robert Drysdale's book on the history of Jiu-Jitsu. I think that book is a real page turner, because you have this thing where in Brazilian Jiu-Jitsu, a lot of the people that were actually instrumental in the development of the sport prior to the Gracies all dying, and that history is being lost. And we are under the impression, rightly or wrongly, that one family dominated the development of the sport. And I don't think that's correct. I think that there were a lot of people that Maeda taught that, we don't know about, because those people weren't marketing experts.
Right.
I think
I've done a fair bit of reading and and research as well. And I've noticed that there's a big, that's one thing, as access to media and like where the, if you were in Rio, it was one thing. If you were in sort of the outskirts or an outlying town and you were still doing all your stuff, then you didn't have access to promote yourself. So
yeah, it was one of those things where, we don't hear a lot about the Valentis. We don't hear a lot about the Barreto line. We don't hear anything like, you don't really hear about some of these old masters like Osvaldo in Manaus, and how there were 3 styles of jiu-jitsu, and the Manaus style was like a really hardcore, and a lot of the modern era's top teachers came from the Manaus area, not necessarily just Rio or Sao Paulo or stuff like that. And I think that's a really important thing, is that the history of the sport and the development of the sport, it's getting lost now with all of these legends passing on, and they haven't documented a lot of this. So Robert's book is fascinating, absolutely fascinating.
It's on my wish list of things to, I haven't read that one either, but I'm getting ready.
Do you have a copy of it?
Not yet. I'm going
to organize you a copy of it. So
you're awesome. Thank you.
I really enjoy the sort of transparency of it. I mean, I've been a student for 20 odd years like you, and you sort of get not brainwashed, I think indoctrinated to a belief that this is the way it was founded, blah, 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 blah. And you go back to 1993 or 94 when the first UFC happened, and you've got those first videos that came out and everyone bought them and they were all wrong. Like the techniques that were being taught there were like setups for, people to win future tournaments kind of stuff. I think
narrative about how, it's explosion in the United States and around the world, for sure.
Who else is an interesting guy to read about is Chris Howder. When you start hearing how he talks about the development of the sport and how he was in Horian's garage and, learning from there. And Hickson's really honest about the relationship between the brothers. And, it's interesting. Even when you think martial arts unifies, you can still have a dysfunctional family. That's the thing I learned.
Some of that wisdom in there, if you're doing jiu-jitsu and you're doing trading, then, you can.
Oh, it's brilliant stuff. It really, it's sort of like, oh, that's a really interesting perspective. And I think if you want to apply a trader's mind to not only how you train, you should use a trader's mind to how you trade, or a trainer's mind to how you trade. You've got to look at trades like financial jiu-jitsu. You've got to create your edge in the technique, and the technique that you have, you've got long calls, you've got your strategies, right? Those are like your techniques, and you can't just use one technique. If you are only good at an armbar from the guard and you're now in mount, it's not going to work, right? And it's the same thing.
Has mounted you, and you're trying to armbar.
Yeah, the market has taken your back and sunk its hooks in, and now you're stuck. And this is the thing where a lot of false advertising, and this is, I blame YouTube a lot about this, right? There's a lot of stuff on YouTube that is just outright garbage. It is just, it's dangerous to your health. It should come with a public health warning. And, you know, a lot of it is, you know, a lot of it's good. There's a lot of good stuff. But if you have no filter that allows you to actually work out whether something's garbage or not, you're going to fall for everything. You're going to fall for everything. Anyone's going to come out, convincing salesperson number one. Bang, he's going to lead you down a path that does this. And then you're going to find another guy, and you become addicted to finding the next best thing. That's the
I think that's something that's changed a lot since, especially since the internet, is that it used to be that, you know, information was this thing that you couldn't get. So it was, information was the kind of the goal of like finding information. Whereas now it's filtering all the nonsense out of the information. There's so much information. You know, the wisdom isn't in finding information. It's like in finding which information is worth listening to.
Perfect. That is, you know, for anyone listening, that is the key. It's learning to discern what's usable and what's junk. And, you know, there is just so much garbage that sits out there. Honestly, if you don't have a filter, and this is why I say to guys, you've got to have a trade plan that sets up rules. All right. So if someone comes to me and says, Chris, you should be buying stock B. All right. And let's say it's a guy at the gym, and he basically handed me this when he had a towel around his waist. That's one thing for you guys, right? Never take a stock tip from a guy who's not wearing pants. Okay. If he's got a towel on and he's at the gym and he's just gotten out the shower, you don't take a stock tip from the guy. Similarly, don't take a stock tip from a guy who's got no vested interest in you doing that, right? That's the next best thing, right? Don't ever take a trade from someone who's got a vested interest in you doing the trade. So when you've got the rules set, right? If someone gives me a tip, if someone says to me, hey, have you looked at this trade? I will go to my rules, and my rules say I will not trade unless it's got this. I have 5 conditions that it needs to meet. Thanks for the tip, Johnny. I appreciate it, but it didn't meet my system's rules, and I'm not going to trade it.
Yeah.
And it's that discipline that's important. You cannot have a trade system that just works on an email message or a WhatsApp alert or whatever it is. That is not efficient at all, because you might be taking a trade from someone whose risk parameters are completely different from yours. And now you can't tolerate the volatility. You land up oversizing the position. It goes pans. And then you sitting there going, well, I lost. And he goes, oh, well, you overpaid for it. I can handle that 1% loss. You unfortunately put in 10%, and now you've blown up your account or whatever it is. That's what you want to avoid. So having a proper built system that says, I will not trade unless it's this, and this. That's how you start. That's the most important learning skill for a beginner in trading.
That's why I like what you're doing with Alpha Hunters, is that you have trades that you're sending out, but it's always, you know, here are the parameters, here's what you should be doing. And then you have this, obviously the webinar to educate people, and they can come in and learn how to do this stuff instead of just relying exclusively on you all the time.
Well, this is where I know a lot of things went wrong for me in my trading journey back at the beginning. All right. Back at the beginning, you know, 20 years ago, there wasn't this kind of information, right? You couldn't just sign up to a Discord server and get, you know, 900 notifications a day kind of stuff, right? That's garbage for people. That's like crack for the head. Okay. It's really, really bad. So 20 years ago, you would literally be on your own in the market. You like, what do I do? And then you got to go read. Oh, I'm going to learn how to do a covered call. And you do the covered call and it doesn't work. And then you read more and you go, that's why it didn't work. But if there was someone telling you up front, these are the 5 pitfalls of that strategy. These are the things you got to be careful about. Here's a trade. But remember, if this happens, you do this. If this happens, you do that. Blah, 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 blah. Imagine the learning curve that you'll be on and how independent you will be over time. Because the goal of a trader is to operate independently of someone else. It's not to be just replicating, you know, trades. When I do a trade, I try and give the idea. Here's the trade I've done. When I send out my alerts, I've already done the trade. I've done the trade at a specific price. I've said to people, here's what I'm going to do. I'm going to close this when it hits here. I'm going to exit the trade and take a loss if it goes there. and I'm going to take profits there, and I'm going to probably watch it this way. That doesn't mean it's the only right thing to do. It's basically to demonstrate to the subscriber that, okay, I need to have an exit point. I need to have a profit target. I need to have a management system. I need to be able to manage the position in line with my plan. And trader one might say, I don't like Chris's trade because they're a 1-for-1 risk or one for one risk reward. It's not, it's not within my trade plan. So I'm going to do a 68% probability put spread. All right. Multiple strategies of the same tool. It's like having a hammer with a different handle. That's all it is. But you manage them on the same basis, right? You've got to have an exit. You've got to have a stop loss. You've got to know where to, drop out of the trade when it's broken. And most systems don't do that. Most systems don't do that. So what I did with my indicators is I've tried to build something that takes away the intellectual need for someone to sit there and go, well, what do I do next? Like if you don't know what to do, you're going to randomly do something that might be damaging. So, with the alpha hunters thing, what I'm trying to educate them on is this is the hammer, but there are multiple ways to swing it. You can swing it from over your head. You can swing it this way. You can backhand. You can do whatever you want. It's still a hammer, and the trade is the hammer. So how you manage it is what your favorite, what your favorite swing is going to be. Right. Many trade systems go wrong because they say it's all about the trade. It's not about the trade. I will tell you now, finding easy, trades that are going to work is the easiest part of trading. Okay, so most people put too much emphasis on the alert side and not on the management of the trade. So they want the alert, but they don't care about the management. It should be the other way around. If I give you the management, any trade will work. Okay, it's finding those easy trades, finding the trades that are going to work, not hard. It's managing them correctly so that you don't have a winner become a loser and you don't have a loser become a big loser. That's the hardest part of trading. And unfortunately, most indicators don't do that. It's not based on indicators because 99% of the time, you'll have an indicator on your screen and you won't listen to it. Oh, it said sell. Yeah, but I just got in 10 minutes ago, so I'm going to wait. Right. No one trades like that. Okay. Oh, everyone trades like that. No one goes, oh, here's my exit signal. Am I going to exit? Yes, I'm going to exit. This is an exit signal. I had one signal, two signals. I had two signals on that candle. In fact, if you look closely on this chart, the first exit signal is where that green line here goes red. There's your exit signal. So there's one signal, two signals, three signals. We had three signals in an hour and a half of trading to tell you to get out of the trade before this price decline. So what happens is most people will exit the signal or not exit the signal. They'll go, oh, it's at the 34, it's going to bounce. Yeah, it did bounce, but you had to go through all of this, and this can kill a trade. So if you've exited the signal there, when the price crossed the 8, okay, that's our first exit signal. Then we had the 8 cross the 13 over here. So there were your two, and then we had a momentum reversal as well. So you had three signals all there. Most people don't trade like this. They don't go enter, exit. They don't do this, enter, exit.
So do you like to use a confirmation for your entries, but you like to get out on the signal?
Yeah, so what I would do in this situation, this is a 30-minute chart. If I was doing a bull put spread expiring on the same day, this is not my exit signal. All right, I wouldn't use this as an exit signal. I use this as an entry, but not the exit. The exit would be time bound because what I'd be doing is I'd be selling a put spread on this signal somewhere down here as a strike, right? So I'm going to sell the 45.55, let's say, over here, and I would be holding it for time. All right, if this was yesterday, what is this? 1st of November, let's go over here. So if I got that signal on the 28th at 10:30, all right, what was the 28th? That was Friday. So it's a day zero expiration. On that signal, I would have sold a put spread somewhere here, 45.55, say, and I would hold it till the end of the day. It would be hold till 3 o'clock because it's the same day expiration trade. And I just need the price not to drop below 45.55. It's a cash settled index, right? So you can sell these, I sell them up front a few days in advance, looking at the Fibonacci and Elliott wave. and I get price predictions. So I can sell them at prices where the stock is moving towards to go in the money. So we would be risking maybe $100 for $800 kind of thing. And I teach that in my day trading class for SPX. Yeah, so when you're selling an SPX put spread on, you would use this signal, the reversal signal, to enter, and you would hold till the end of the day. So if you'd entered a trade here at the 45.55 level as your short at 10:30 in the morning, at 3:30 that afternoon, the price was still higher than 45.55, you would have made 100% on the trade. So it's a process, right? If I'm doing that trade on a Tuesday, completely different, because there's no 0 day working in my favor, right? So you have to have a plan. So when I write down, okay, it's Monday, I'm going to do X, Y, and Z, I follow that. I enter on the signal, I exit on time. If it's Tuesday, I do a different kind of trade. So when I teach the day trading stuff, it's more around building that process of what you are going to do when something happens. So when that signal comes on, what do? Okay, you can either enter a trade, you could put a third of a position, you could do whatever, and then how would you manage it? Again, so something that I teach in my day trading course.
Nice. Well, maybe next time we can just spend a little more time talking specifically about day trading.
Yeah, sure.
I'm going to have to wrap up here, but I really appreciate your insights, Chris. I'm sure all of our viewers do too. So head on over to Rogue Investing /alpha and check out Chris's service. So he's got some new things coming down the line too. So be sure to look out for that. Get on our mailing list. Chris, I appreciate it, man.
Take care, Brian.
Good stuff, good info, and have an awesome day.
You too, my friend. Take care. We'll see you next week.
Yeah, see ya.
See you. Bye.